Okay, so it is 5:30 Calgary time, 7:30 Toronto time. So why don't we kick it off relatively quick here? And we're gonna, hey Lyle, good to see you. Barry's still at the office, so he's putting in a full shift. He is going to hand it off to me, and I'm going to run through and give you a quick market recap about what I see in the market today, and then I'm going to flip it into my hardcore presentation on oil and gas. So go ahead, Barry.
Yeah, feel free. Yeah, so like Greg said, I'm a little tied up. Don't want to mislead anyone out there. So Greg has graciously uh, stepped in, and I would say he obviously has a good pulse on the market. Through his obviously, I think there's a few people online that subscribe to his website. That's provided great information. He has his own proprietary strength indicator that's been very useful, looking at breadth when time to potentially enter and exit the market based on his breadth indicator. So without further ado, I'll let Greg take it away. And like you said, he'll provide a bit of a market overview to start, and then I believe he's going to go into some commodities and energy as his core presentation.
Perfect. Hey, thanks everybody for joining me. Best of the season to you. Hopefully we've got, I just want to clean things up here. Did that stop my video? Okay, what we'd like to cover off today is a couple of exciting things. I think one of the things I'm most excited about is that we have a big bull market building. I think the vaccine is part of that, but we were also set up for kind of two other things to kick off. And one was that the market seemed to be stuck. I don't know if that's the right word, but stuck from 2018 to 2019 due to the trade tariff talks between Trump and China. And that trade tariff tennis that went back and forth slowed most of the commodities in 2018, 2019. And then literally in the fall of 2019, and I'll show you on some of the charts, on the fall in 2019, we started to break out, and then COVID hit and rolled everything down. So when you think about taking 1/3 the market cap off the world in terms of the stock market, that was a pretty abrupt hit. And we know that restaurants and hotels and stuff like that are going to be hit hard. And one of the disconnects that we're currently having is that everybody wonders how could the stock market be doing so well with these locations closed and hurting so much. I think the most important thing to remember is that they were not the leaders of the stock market before. While they were in the market, they weren't the leadership. And consumer discretionary was in a big way, but consumer discretionary is a much wider area. And because online, like if we'd have had this 20 years ago when nobody was shopping online, I can imagine it would have been a lot more difficult for us to pull off. But with the current situation and the amount of money that the governments threw at it worldwide, it was at a civic level, a municipal level, a provincial level, a federal level, state, federal, over in Europe, everybody, Japan jumped on with another couple of trillion for friends. It was a central bank party. And so I do think we're going to have a big 2021 bull market, mostly due to the amount of money the governments threw at it. Now, our children are probably going to enjoy the moment when they have to pay for it all. That's not really for us to worry about. So let me show you the agenda tonight and just really briefly hit that off. And then I'm going to jump straight into the charts about North America. Why is that beeping? There we go. About North America, US and Canada, what we see there, and then jump into why all of these things, the big picture, all line up to me to be a big bull market. And we've got currencies, bonds, stocks, commodities, chart shapes that are just starting to break out on big monthly charts that I think are, breathtaking in terms of the size and scale of what could be ahead of us. And the fundamental data, I don't try to cover that off too much, but a little bit of we'll mention it as opposed to focus on it. So how's that? So let me jump over onto my browser. And I'm just going to get into this chart. Okay, so here's the S&P 500. And of course, obviously, I'd like the Canadian market to rule the roost. I'll show you that chart in a second. But the bottom line is we really do depend on what goes on south of the border. So for a 1 month to date picture here, we're, up 3%. Not huge, but nonetheless, we'll take that every day when we can get a nice rise out of it. So this is the S&P 500 um, daily. What is? Whoa, something went wrong there. This is supposed to be my. Let me just check there. That's the chart I'm looking for. The year to date. And what we see on the year to date, obviously, was we had a massive pullback and fell down 34%. We bounced up 65% so far on the S&P. And we're still trying to break out the top here. Now, the slope of the advance was, pretty aggressive right into the September 3rd period. And the one focus I want to make about that was that the tech stocks were raging and banks and commodities were not. And then came the rally in November where banks and commodities took off and tech stocks have paused. So on the daily chart here, what we see is the PPO, my momentum indicator. So there's the MACD, the PRING, KST, the PMO by Carl Swendlin, the PPO, which is the MACD in percentage terms. All of those basically give you the same signal. What I like about the PPO is it allows me to compare it over long periods of time. So a percentage move in Amazon in 1999 or in 2002 is just as big as the percentage move in Amazon today. Whereas because the price is different, the MACD looks way, way out of scale. If you don't mind, Mark, I'm going to turn off your camera if I can. And let's just see if I can do that. And then I'm going to go up and I'm going to turn off Barry's camera. Stop video. Perfect. And that just gives me a little more screen real estate than pictures piled on the screen. So, so with that, what we're looking at here is the MACD is starting to roll over, or the PPO is starting to roll over on the S&P 500. And it's getting me a little more concerned that maybe most of the good news is priced in and we might have a pullback into January. And then coming out of January, I think it's the Wild West. I think it could be guns a-blazing as the economy opens up. Literally, the charts are set up for this thing to explode higher if I'm correct in my interpretation. So here is the NASDAQ 100. And again, the difference between the NASDAQ 100 and the S&P 500 is on the NASDAQ, we have this picture, which is the price is up nice and high, but we have a pullback in momentum here. Now, it could wave here and stay up nice and high. But the real question is, why is the S&P up so high and why is the NASDAQ not? And when the NASDAQ got up here, I have this little blue line on this chart. Actually, let me go to a different one. And the only reason I say that is because then I don't have to take a bunch of things off the screen. There we go, NASDAQ weekly. And what I want to show here was we were up around 7.5%. Well, if we open this up to whatever, 25 years, just to give you some feel, and we're going to set I'm going to set the height at about 7.5, just to put a solid line on it. And the idea being just to get a feel so that you understand exactly how enthusiastic the momentum has been in this rally. It's quite frankly almost scary because it was so high up. So you see this, we hadn't had a rally this high since 2000 in terms of percentages. Stunning in its size. And now we've pulled back from there. And so So that makes it a little more complex to look at. Now, when we do the same thing with the S&P 500 right now on a weekly basis, we're up here at this 4% level, 3.965. And when I open that up to 20 years, come on. When I open that up to 20 or 25 years, you get the idea. We were briefly this bullish in 2009. We're above the level we were at in 2010 and 2004. We're going back to late 1999. Now, the good news is that none of those prior highs in momentum marked long-term tops. I will say the one in 2004 did mark a 6-month slowdown, so that's something to think about. But for the most part, it was a big bullish back rub, telling us that when we get momentum this high, we should enjoy it. Now, it doesn't mean we won't have wiggles like a pullback into January or something, but in general, I'm expecting a big thrust out of there. On a market basis, just looking around at the different features in the market today, one of the things to just quickly take a look at is the perf chart. And what we see, this is for 200 days. I just want to set it for 1 week. And what we see for 1 week is that if I take the S&P and just make it flat, what we can see here is that the consumer discretionary popped up a lot today. Energy, even if I just went back 1 day, just need to get in here a little bit there. Energy was the lone positive force last week, and then this week changing it up a little bit with a little bit more consumer discretionary. Might need 2 days there, with consumer discretionary having a big day today and utilities up a little bit. Not so happy about the utilities being up, but the point I want to make is that in general, the market's been getting softer. We're not getting the broad participation that we would like to have. And so that's one of the reasons that I think we're getting slower. Now, this is mostly today's price action. It's for 2 days, so yesterday and today. But what you can see is broadly up across the table. And within the S&P 500, it was mostly bull market stuff that went up and defensives that went down. So that's probably pretty good. Communication services, I think, also has telcos in there, so they can be a bit defensive. But looking at discretionary, it wasn't as that big today, but these other areas, materials, energy, these are the kind of things we want to see cycle up. And then financials and real estate have been part of the back to work or end of COVID trade. So with the market set up the way it is, we're still getting a broad push, but it's rotated from technology over into, I'll call it the post-COVID environment. I want to touch on that post-COVID environment really quickly. So one of the things that they were focused on was that, the US might screw up the delivery of these vaccines and that kind of thing. No way. I was in transportation for years with Shell, and then after that with Thermo King. I also did some time with a data networking company in Canada, building out communications networks 20 years ago. And I would just say, even back then, we were developing cold chain technology to be able to track the temperatures as product moved through the pipeline all the way along. We know where the trucks are. We know where the pallets are. We knew what was going on. So I'm fully comfortable that we are going to move the vaccine safely worldwide. We can move sushi from Japan. We can move, Wagyu beef from Canada to Japan. Things that, if they aren't done right, people can die very quickly. We don't have that same situation with the vaccine. It's the packaging is set up for it to work. And once it gets to a site, then it has to be unthawed and delivered. They talked today about it on CNBC, but I'm very confident in the whole vaccine distribution network. I think that will be a non-issue. The big mother lode for me was today when Moderna said that they tested between their first and second vaccine when you went to get your second shot. And what they found out was that the people who had got their first shot were not only being infected by the vaccine, but they weren't by COVID, they weren't carrying it or transmitting it either. So the Moderna vaccine actually blocks the transmission between people, just even with the first injection. So if you think that we could roll out 50% of the population in the first 3 months, and that's kind of the estimate, what we're looking at, we think that, or I think that by the time we get 50% of the people vaccinated with a lot of the, we still have to get through the anti-vaxxers and the I'll call it opposition to moving this thing forward. The bigger opportunity here is once we start to see that slowdown in transmission, I think the economy literally sets sail and it will be like a cruise ship leaving port. We'll be pretty much on a nice upward glide with people getting back to work. I think cars are going to hit the road in an unbelievable fashion. People are going to Disney parks probably, I don't want to be near one this year. I think they'll be smoking busy. Vegas will be crawling with people. The desire to get back together with everybody, I expect it to be massive. And Paul Tudor Jones, BlackRock, Blackstone, everybody's coming out with relatively optimistic forecasts about that. So I'm really, really bullish that way. Now, let me go get a chart for you that just suggests in my work that things are slowing down slightly, just from a near term, like over this. These are weekly indicators, and what happens on these indicators, I'll get another version for you right away, but on this indicator, this goes back 2 years. When the market started to rally out of the hole, this indicator runs up quite nicely. And then we have these jagged periods, and this was the September through October period, and we were dropping down here. And then literally we turned and we fired off to the top side. And when we do that, my whole goal is to kind of build cash till we get here. And as it starts to move up, I want to get on board. And what we saw here at the end of October was my fastest indicator had started to improve. And then we literally had the lightning shot where we had the election and then we had the COVID data come out from Pfizer. And that just sent everything soaring. Well, now that data, as of yesterday, was rolling over. This is weekly data. So the problem I have is when I print it for 1 day of a week, it's really not giving me the same sort of context. So if that day is down, it behaves a little bit rough. If that day is up sharply, it would change this back. So I think if I did this data, if I ran the data again tonight, this probably wouldn't be as rough looking. And what I want to point out is that even if this carries forward a little bit, we have been weakening. We were at 82. 81, 82, 78, and now dropping below 75. And normally I find a good place to at least get off margin if you're on it and trade with tighter stops is when we get below 75%. So what this indicator helps me track is I have a group of charts in a chart list, and I go through and say, how positive is the momentum on a weekly basis? And I use different indicators to try and get a quick rate of response, a medium, and I'll call it a slower, more distilled, calmer chart. So you can see in the May to July period, my faster indicator wasn't giving very strong results, but we were still way up at the top in terms of the overall influence, and the market kept pushing higher. So it's a tool I use just to try and get a feel for if things are slowing down. And even, the 3 days last week wouldn't really do it that much damage. The problem was it's been 4 weeks that we've been actually slowly losing our upward momentum. So if the market wants to keep running here for another few weeks, 2 or 3 weeks, that would be great. I could live with that. what I really want to get set up for is 2021 at some point, and I don't know if it's in early January, late January, mid-February, we are going to turn from being focused on the high number of COVID deaths to the response by the economy. And as the vaccines start to stop the transmission, I think that's where we really get the gas pedal. And um, that moment, you could wait for it on a chart or whatever, but I think the real key picture is don't get too bearish here. Don't try to short the market because we're rolling over a little bit. Just get ready with the names you want to own so that when we start to run, um, and maybe you're already in them, but if they start to pull back and kick you out on your stops or whatever, be ready for that big initial surge in January, February. There's a couple of main pieces that are different here. In the past couple of years, we've had China slow down, America slow down due to the tariffs. We've had, in 2019, in December, the Canadian economy had the lowest job growth since 2009. We were struggling to get any sort of positive momentum. When you looked at Europe, their charts were weak as well. So all of that adds up to being a relatively subdued situation. Then we had the COVID flush and literally the rush of money from every piece of government we could possibly get. They have no idea how they're going to fund it. But all the governments basically threw money at it to keep it going, which is fine. The thing that we need to recognize is there's a bucket load of stimulus out there pushing everything up. And, I think we're spending $3 billion planting trees in a country with some of the largest forests on the earth. You can't make that stuff up. Anyway, we're going to keep rolling this thing out, throwing money at just about everything to get it pushed forward. And I think it's not Canada, it's not America, it's not China, it's the whole world coming out of this thrusting together. I liken it to something around the end of the Second World War. In July of 1945, we signed the declaration in November, but by July, things were starting to improve. And the stock market actually took off all through July, and it went all the way through to March. If you just think of what we keep hoping things were going to get better, and then we knew the second wave was coming, and then we had Canadian Thanksgiving, and we've spent 2 months kind of struggling to get past that, and almost all the provinces are hitting new highs in terms of hospitalizations, roughly 2 months from Thanksgiving. The issue for America is their 2 months from Thanksgiving is the end of January. So they're probably looking at the same sort of bubble that we're living in right now, lockdown bubble. So as we come out of that, that's a global thing, and the vaccines going, especially through the developed world very quickly, are going to push the stock market quite aggressively higher. China, India, Brazil, Japan have already started using more oil than they were using before. So the backdrop is ripe for this whole globe to just explode higher. And I think at the time, at the end of the Second World War, if you go back and look at the Dow, it ran up about 30% in 9 months, which obviously, and that wasn't from the lows, that was just from like mid-July 1945. The reason I picked that was just because it was kind of when you started to see the end of the or the light at the end of the tunnel, and as things started to expand out of there. So if you just took even half of that and put another 15 or 20% on the Dow, and you're at 33 or 36,000, the TSX quickly moving up over 20, we could really see some big moves here. So I think you want to try and maintain your optimism, not pessimism, about vaccine movement, and try to use that to your advantage. I think we're really well positioned, but it might not be the tech names that move. And the reason is because especially the Apples and the Facebooks or whatever, they were the ones where everybody moved into their stock because they had the cash flow, they had the um, balance sheets to weather whatever went on. And it used to be that we would run to Walmart because that stock was kind of the stalwart in terms of people would need it or whatever. Well, when everybody was forced online, that really helped all the majors. So I don't know that they get the push the second time. We might still find pushes in the newer names, not Zoom and not Peloton, but in newer software technology names, maybe like Descartes Systems, which is a trucking software. Um, anyway, I would expect some rotation within software, and it might not be the names that shone before. So let me start back in on my PowerPoint here. I just want to show you a couple of charts to set the stage for why I think we're about to explode higher in oil. So this is a chart from 9Point. Well, I saw it on 9Point, which is Eric Nuttall, who is an energy fund investor in Canada. And what he put out was that the pre-shale period, the average West Texas price was $77. And really, I would even break that into two. It was 100 and then it was 60. And then we had the US shale period in around $60 for an average price. And then we had the COVID here where we dipped down hard and we're starting to bounce back up. But one of the big things we see here is this huge decline off the top. There are many people that want to think that crude isn't coming back because we're going to move to electric cars. I really need to help share how much work has to be done on the grid for that to happen meaningfully. But we're not going to get into that tonight. What I want to talk about is the best time to buy commodities is when they bounce off the lows, not after they get back to 80 bucks. Like, I don't want to wait for crude to all of a sudden be like the brightest star out there. I want the ride while it's on its way to being the brightest star. So I don't want to buy crude at 80 or 100. I want to buy crude at 40, knowing it's probably moving back up if there was demand. So let's talk about that a little bit. Last week, while all the other charts were hurting, energy was the only thing really popping up. And this was as of the close on Friday. But the point of the chart being, we haven't seen this sort of thing in energy for 6 months since the whole COVID thing, probably even since the beginning of the year when China first started to see COVID. That's when the commodity charts started to break. So we have something really big going on. Now, we're technicians in this crowd, and one of the things that we like to use are charts to kind of talk about our point. One of the things that's happened, and Pring, Murphy, McClellan in the case of this chart, and he was nice enough to let me use it today. If you go back and look through time, gold is usually the first commodity that breaks out to the upside, and then other commodities start to follow with some lag. McClellan's got it that it's a 20-month lag for oil, and wheat could be different, copper could be different. All of them could have a different lag time. But what we do see is that normally when we start to see a bull market in one commodity start to develop, eventually we start to see bull markets in other commodities start to follow along. The big thing for me in this one was that, we were at $149 for oil back in 2008. We crashed to zero. It's not going to go any lower than zero. Well, it can briefly overnight. But what we're going to watch for now is as we climb out of this hole, we have two major factors. And one of the factors is that I see a global expanse coming, like I just talked about, almost the post-war period where optimism starts to set everything afoot. And we've got huge government stimulus to help that forward. And then we have the situation that literally nobody wants to drill for oil. Nobody. Shell has decided they're not going to drill. Total has decided they're not going to drill. So when we work through these charts, we have a lot of, even oil companies resistant to put money into reservoirs right now. And yet it's right at the point where we're turning up the enthusiasm for the global economy. So here's what Shell says. We peaked our production back in 2019, and we're not going to go past that high point ever again with our oil production. So they're actually planning on never getting better or higher. And when you go to BP, they do the same thing. Exxon has done the same thing. Repsol has done the same thing. Total has done the same thing. Now, one of the key points to make is that not only are they not planning on spending it going forward, they haven't been spending it for the last 5 years. So Shell has the Kitimat LNG terminal project going on right now, and they're a partner in there. That Kitimat project is a pretty big one, $20 or $30 billion, 5 or 6 car plants as an example. And it's rolling forward, but it's natural gas, not oil. And what we find is that the best cure for commodity prices is low commodity prices. So in other words, when everybody leaves the farm and everybody stops producing, that's what makes oil turn. I think we're there. And it's this kind of stuff where the majors have just said, we're not even going to spend the money. Now, they said that after the 2014 market crash from 100 to 25. And then it bounced back up, and they still weren't signing off on any real big projects, or a lot less big projects. But they were doing, regular drilling and offshore drilling in reservoirs they knew, but they weren't really looking for the next mother lode and putting out $20 and $30 billion projects. The number of those projects that are going on around the world has greatly diminished. And I think that's one of the keys to pointing out why this is going to be such a big bull. So this is the data from 9 Point, Eric Nuttall. And what he's done is he's taken the U.S. crude oil inventory year-on-year surplus and deficit. And so in the middle of 2019, roughly in the summer, we had $55 oil. And we recently got right back up to that same sort of level. So we've actually been above and below that. And with that, we're back here and we're at $45 oil. So we're $10 a barrel less, even though we have about the same oil in inventory. Now, it's not uncommon for us to build oil inventory in the winter. So we could have some short-term price issues. And I use the word issues because if we have to lock everything down again, yes, we are going to dampen demand by 5 million barrels a day for a couple of months. And as we come out of the backside of that, though, I fully expect the accelerator to get hit. The point I want to make is that we are relatively close on our inventories. Yes, we have some lag, but the real area that we have to worry about is not that what the demand is going to be. It's the supply side. I think that's the critical component. So here is from Goldman Sachs, their call on how much new projects are coming on outside of OPEC and not including the US. And so they show that basically from 2020, this was kind of the new project stuff going on. This is the gap coming forward. Like, we just literally are going to be well behind supplying new reservoirs. So much like a gas tank in your car, an oil reservoir is a fixed volume of fluid, and then we crack the rock formation to get the oil to flow to the wellhead, and as it flows out, we pull the oil out, and then we use it for gasoline and refining, and we use it for petrochemicals, we use it for propane for your barbecue and patio heaters, we use it for making clothing, Lululemon line, all of that kind of stuff all gets made from oil. So we have not just the fuel driving down the road is 27% of global demand. And we literally stopped the world, and we went from about 103 million barrels to about 80 million barrels. We took 25 million barrels a day off by stopping the economy worldwide and then turning it back on. And there's a whole bunch of people that think we're never going back. And I just have to say that we only have 1% of the cars on the road with electric, and we need a grid to double in order to meet any sort of major expansion in that, which isn't going to happen in 1 year. And so I think we have this opportunity where we've been burning gasoline through the year, we've been burning diesel through the year, and we had some in tanks on refineries and that kind of stuff. But the underground reservoir, normally what would happen, my a friend of mine who owns a small oil company, 4,000 barrels a day, I asked him what his decline rate was, and he said, Greg, I'm about 10%. So what that means is that if he doesn't drill a well, his production will drop by 10% year on year. So if you take 100 million barrels worldwide and just drop the production down 10 million barrels, from 100 down 10 puts you at 90. The IEA expects us to be back at 96 million barrels a day by the end of the year. So we have reservoirs declining every day. Last week was the first week that we, actually, I think it was the first month that we started to make higher totals of drilling rigs being used than the months before. So we were decline. And now last month, we actually started to increase the number of drilling rigs. But in the meantime, we've got all these wells declining worldwide. There's some reservoirs like the oil sands that don't have a decline rate because they're 50 or 60 years of inventory, and you just get the same amount every day. So you can't use that 10 million very easily and average it all out. My main point would be that if you just said we lost about 5 or 6 million barrels of production, the major oil companies aren't doing anything to help us get out of the hole. The little guys who have no access to capital because nobody will give them a dollar because, somebody went in and said, from an environmental perspective, we don't want you to fund that. Okay, so we don't have enough little guys even drilling. We don't have the big guys drilling. We have declining reservoirs, and now we're about to start the world on the biggest probably economic boom with government stimulus and optimism and everybody coming out of this clampdown. We have the exact makeup for a big boom where we don't have enough supply, and we actually by the end of the year have demand exceeding the amount of oil in the system. Now, do I think our reservoirs our oil tanks are going to go to zero? No, but what happens is the price of oil will go up. So if we have a 600 million barrel worldwide inventory and all of a sudden that gets down to 400, the price of oil will move up meaningfully, recognizing it's lost 200 million barrels of oil. So, and if you just take how many millions of barrels a day, we go through 100 million barrels of oil a day, and whatever our global inventory data is, when you start to get offside, it doesn't take very long for things to catch up. So it's that kind of backdrop from a real quick fundamental high level 50,000 foot view. Don't bother getting into the actual numbers, just general concepts. The fact that the oil reservoirs are going down and nobody's restarted their drilling in any meaningful way. We don't have $30 billion projects starting up. And those projects, just to get them green lighted by government, take 5 years now. So, if Suncor wanted to expand their oil sands, there's a whole host of people that want to stop them from doing that. Yet nobody's recognizing the problem that we might not make the transition to electric before we get out of the current situation we're in. So all of those things lead me to believe that we have a big opportunity ahead. And this curve on the right here, so everybody normally assumes that, of course, the U.S. shale reservoir is going to be, just like it was before. We're going to go back to the Permian and we're just going to drill it, and that's how we'll get it back, and money will flow and it won't be a big deal. Well, the real problem was in the Permian, in oil reservoirs, much like in gold mining or whatever, you have a certain percentage of oil in the rock, and then you have a certain percentage of connectivity between the holes, between the oil holes in the rock. So you've got little pockets of oil, and then how they connect is how much oil you're able to get out. So what happens is we divide that into quality, and we say this is a tier 1 reservoir, tier 2 reservoir, and this is not a very good reservoir below that. Well, what happened in the Permian as price of oil was trying to move up was they were drilling all their tier 1s as fast as they could. So they would literally go in, and in 90 days they'd be making their money back. But the problem was the decline rate was so fast. You drilled one well, and in order to just keep your production flat, you had to drill 2 more wells. And so you had 1, 2, 3 wells, then you had to drill 5 to keep 3, and then you had to drill 8 to keep 5, and then you had to drill 13 to keep 8, the Fibonacci sequence, where in order to grow, you have to have a rising ratio. And eventually what happens is you're trying to do 200 wells to keep 144 going, and you just can't, you physically can't drill that fast. So first of all, you start finishing your tier 1 reservoirs, then you start to get into tier 2 reservoirs. Now you got to drill even faster to get that done. Well, what was happening towards the end of 2019 was that the US Permian was not being drilled or given capital anymore, because basically they were on a treadmill. You put the money on the front of the treadmill, and literally 6 or 8 weeks later, it was off the back of the treadmill, and it was just flying by, and there was no real long-term value being created. So people, investors got tired of kind of putting money in at that rate of return, and they stopped. And so what Goldman thinks is going to happen is, this was 2018. This is the peak of the Permian, well, call it the shale globally in the US, but the main reservoirs would be the Eagle Ford and the Permian. And when you have these reservoirs, this is where we're at now. We're already down here. Well, guess what happened in 2020? We actually weren't here. We're down here because we're no longer drilling. So we probably took a whole year out of this thing already. And the run rate is running way down. So we've probably hit peak Permian by a couple of million barrels a day. That, even to get back to flat, would be almost impossible, because we don't have the tier 1 and tier 2 reservoirs there anymore. So it's big, massive changes that are hard to explain. Hopefully I've simplified it enough to get the point across that the Permian isn't going to be our solution. The large majors aren't going to be drilling big $20 billion projects offshore anytime soon. When we go to the rest of the world, the Middle East is still unsettled a bit. They're firing rocket shells at other people's infrastructure and that kind of stuff. We've still got some tension between Iran and America, so that's a problem. Venezuela is a big oil producer, but we got a little bit of instability there. Brazil's a big oil producer, but again, they've got a lot of COVID issues, and their big company Petrobras is going to struggle to get capital to build out as well. And Mexico's been declining. So we're literally going around the world having trouble finding out who's going to pump this extra oil and where's it going to come from, especially in the short term. Okay, so that's as fundamental as Greg likes to get, because I like to focus on the charts. So I'm going to go over here. Actually, I'm going to change that. I'm going to go to this Adobe presentation that is part of my newsletter each week. So just if you don't mind, the reason I want to do it with this newsletter is because it actually puts the stuff together in order. So, so the currency started to move a couple of weeks ago. And what does that mean? This chart is not moving as fast as I wanted to. Let me, got too many things going on. Let's see if I can fine tune this. This wasn't supposed to be this difficult. What I want to show on here, okay, and if this doesn't cooperate, I'm going to quickly quit and go to Microsoft Word and grab the Word document. Okay, and what I want to show on here is as these stocks started to come in, um, I'm just going to jump down some pages here. As these stocks, the rebound started to come into the economy, one of the big clues that we've got is that the US dollar has broken a 10-year trend line. Now, that may or may not sound significant to you, but the real magic of this 10-year trend line, when we go directly to the charts, is when you see what it did for the last bull market in commodities, which was the '03 to 2008 period. Literally, at the beginning of 2002, the US dollar topped and we fell down to 2008. And to get there, we broke a giant trend line on the US dollar that went back to 1995. And then really from the 2000 and 2002, it was quite an absurd period. But this 6 or 7 year bull market in the US dollar, when it rolled over, that was the next, and I've got a chart for you that will show you that that's when commodities started to kick it up in 2003, and oil went, all the way up to $149 in 2008. Then when the US dollar reversed, that kind of marked the top for oil. These are long cycles, but what we've done is we've had oil topping at $149, and we went all the way to zero in 12 years. If we're about to reverse, one of the biggest clues that that reversal is happening would be on the US dollar. And what we've got is a 10-year trend line breaking, kind of confirming that we are changing trend in the currency as well as in the commodities. So to me, that's a really big influence that we're starting to see. Now, getting through that is pretty important. I'm just going to scroll here. Sorry for that. Here's the Canadian dollar. And what you'll notice is the Canadian dollar, here's oil topping out in 2008. Here's when metals and minerals started to top out. So gold and copper and all that kind of stuff topped out around 2011. And we've been sliding. The Canadian dollar is now starting to break its trend line as well. And you can see that during that 2003 to 2008 oil move, that the Canadian dollar also followed it. So we're seeing it for sure in the currencies. Now here's the Australian dollar, and the point on the Aussie dollar is, this is a short-term trend line, but it's got the same characteristics as the Canadian market. It's really starting to break. And in England, even with Brexit and everything, they have a lot of metals and minerals listed on the British exchange, the London stock market and London metals exchange. And even that stock market in the middle of Brexit is having a breakout on their currency, which I find phenomenal. So that's a good place to start. And then this lesson from John Murphy was that the emerging market currencies typically move with commodities. And so I put the price of copper in here in orange. What you see is, for the most part, the emerging market currency ETF pretty much follows the price of copper. And now copper's gone to the moon, and copper's at 7-year highs. Emerging market stock market is breaking out up here in the top, and the currencies are starting to go. Our big downtrends in momentum literally started with the tariff talks in 2018 and started to break. Like, I could have drawn a trend line right through here, and late in 2019 they were starting to break out. And what happened is we ran up here, and just as China got COVID and then it started to go around the world, this whole thing fell apart. So we were starting to break out on the end. So on the phase 1 trade tariff agreement, I guess is probably a fair way to call it, because they were by no means done their trade tariff discussions. But phase 1 was going to be finished. So they were starting to break out, and we were getting out of this 2-year rut in commodities. And now all of a sudden, now with Trump not there, with Biden there instead, there's a lot of optimism that probably we won't have the same trade tariffs coming back. And so this is all starting to break out. The currency is breaking out to the upside. Copper's already broken out. Gold has been broken out for a year. And now we're expecting other major commodities to start. So here's Russia's stock market. Topped with oil in 2008, topped with metals in 2011, came down here, and in late 2019 started to break out on the back of the tariff agreement, fell down for COVID, and we're literally just going across that line now. So that's a very big commodity country like Canada. And when we look at Brazil, Brazil's almost taking out its 2020 high here. As it tries to climb out of the pandemic. And what I particularly like is that its momentum indicator ran up, pulled back, and is now starting to accelerate away at an above zero level, positive. So it's really starting to turn up. And here's the emerging market ETF. I showed you a miniature of it, but this is clearly on its way. It's breaking out to new highs past 2018, and we're in this big bull market for emerging markets, which is commodities. Now, China had the 2-year downtrend going on with the Trump tariff talks. And then in June, July, it started to break out, made a bull flag, started to break out. Recently, like last week, it made a 4-week low. So I really wasn't happy about that. So we'll need to watch what's going on there as to why it might start to be slowing. But when we get into the Canadian stock market, we had the same thing in late November, December. We finally broke out of a 2-year rut that we were in with the trade tariffs going on. And we finally broke out. And just as we did, then COVID hit and we've come back down. We've just in the last couple of weeks started to move back above that line and get going again. So I think from a currency perspective, from global commodity country perspective, both of those are starting to break out to new highs. And that's a really bullish place to be. I don't have other ones in this particular chart list, but let me pull up one more because I think it's I think there's a real powerful move that's setting up when I just work through these charts, and then we can open the floor. If you have questions, I'd really like you to type them in there, and then I can answer them as we get towards the end. So I'm just, sorry, I have to scroll down to get to the charts. So here is the CRB, and what we see is this is the 2020 downtrend, and we're starting to break above this kind of settling area here in around, I'll call it 155. And for the last couple of weeks, we've been pushing above that. Our PPO is now reaching the highest level in a year and a half. The momentum is really starting to surge. And we could go all the way up to this black line before we kind of hit first level resistance. We have a little bit here just under this area. But quite frankly, to get back up to the prior highs and the trend line across it, we'd need to take that down. So here's the CRB on a monthly chart going back. Here's '08, the high in oil, and then this has kind of been commodities forever. So we've been declining. I know everybody thinks there's nothing going on, never will be, commodities are done. Even as far back as the Kondratiev cycles out of Russia many years ago, he found 34 years up, 17 years down. Well, we're already 13 years down, and he just picked a broad range, saying it could be 13 to 20 years for your correction, but your big up cycle starts at that point, and then you start to turn out. Well, I think with oil hitting zero, it's pretty hard to imagine that we have a lot more to go in commodities lower. And now that we're going to start buying all this copper, I think that thrusts higher in order to make wind and solar. In a wind armature, it's filled with copper. In a solar system, it's filled with copper to kind of gather all of the power coming off it, and then put that into a power station and then into transmission lines to move it across the country. If we have to double the grid, as Elon Musk says, you can imagine we're going to build a lot of copper. Now, the second component of that is the whole tower that sits on top of that wind farm to hold up those big windmill blades is all steel. And underneath that is concrete. And when we go to a solar installation, all of the structure is steel. So we need a lot of steel And if you think about doubling the grid, we're not probably going to use hydropower because it's hard to get a dam approved. If you think we're going wind and solar mostly, we're going to use steel and copper at an unbelievable rate. So those two things are almost a given that they're going to start perking up. Now, the question comes down to oil. And my point would be, this was one of the original oil drops in September of 2014, and that really slowed down everything. And at the time, Glencore plummeted. Caterpillar was cutting 5,000 jobs. Anglo American, which is a really big commodity company, I mean, we thought this was tragic. They were dropping 85,000 people out of a staff of 135,000. So they were taking and wiping out 2/3 of the jobs in their company to deal with that COVID or that commodity drop. We went sideways for 4 years and then had COVID hit. So I feel like any flushing that's left to do in commodities is pretty much done. And we have the oil companies all saying, we're not even going to get back on board. We're not going to drill wells. We're not going to do all this stuff, even though we're just getting the signal now that the US dollar is breaking down. So it sets up to this massive opportunity where we have not enough supply. We have a lot of demand because we're about to come out of this COVID situation. China and India, as I've mentioned, have already started increasing demand by 1 million barrels a day over 2019. So even in the COVID year, these two countries are starting to suck up more oil than before. China has now moved to be the #1 refining country in the world. As their demand accelerates, we have this whole situation where those people are just trying to get to middle class, and in order to do that, heat in your homes, um, you know, transportation infrastructure, driving around on highways and freeways, and being able to move goods freely is a big part of that. So as all of that builds out, that's very difficult to do with electric. So I still think we have a huge window for crude oil for the next 3 to 5 years for sure. And we'll see how they're able to get the commodities going in order to get the power generation for electric. So this is the chart of crude, and what we see is this Bollinger Band pinch down to almost nothing for 2 months, and now we're just starting to break out to the upside. This chart, I can just quickly click on it to be updated. We're still riding this upper trend line, and we're heading higher on these commodities. But the point I want to make, we're at this right shoulder of a major low, and we're just starting to get going. And we actually have the benefit, if you haven't got on the train yet, of moving into commodities as I'll call it the COVID compression comes down, where all of a sudden the hospitals get full due to Thanksgiving and Christmas and all that kind of stuff. And everybody gets scared once more about the stalling of the economy. And then you get a chance to actually pick up the stock and take off with the whole thing moving higher. So I literally can't contain my optimism for how much the opportunity sits in oil today. I thought oil would be at $50 by Christmas. It was at 47 and change, 47.74. Okay, maybe it doesn't make it to 50. Maybe it takes January or February to get there. But just to help you with some numbers, so CNRL is now, Canadian Natural Resources, is now the largest producer in Canada. They produce 1.2 million barrels a day. So for every dollar that crude oil moves up, annually, that's 500 million in revenue. Now they have to take some carbon tax off the top of it, and excise tax off the top of it, and royalty tax off the top of it. Yeah, they do. There's money coming out of there. But the main point would be, after living with nothing for revenue for the last 5 years, this looks set to explode higher, and somebody has to make up that volume that isn't coming out of the Permian and the US reservoirs anymore, most likely to be Canadian. So if you just take the move from $47 to $57, and that doesn't even get you back to crude's high in January at 65, that's $5 billion in revenue for CNRL right there. And then to go to 65 or even the highs of 2019, that's 10 billion in revenue. So CNRL bought Shell's assets at about 50% off. They bought the Devon assets at about the same. So they literally picked up 600,000 barrels a day in new assets at about half the cost. I think they paid $8.5 billion to buy the Shell assets, and Shell spent over $20 billion with their partners to build those. So just amazingly, it's like buying a diamond for 40% of what the original price was. It's a lifelong asset, or a 30 or 40-year asset with the oil sands. And I do want to preach a little bit that there's been a lot of environmental programs going on at the oil sands, but be damned if we can get that through the media. So oil sands have cleaned up immensely starting in 2005. As recently as the last 5 years, there's been a 15% improvement in environmental performance. We continue to be the best in the world. And if we could get the rest of the world to produce oil as clean as Canada does, we could drop greenhouse gas emissions worldwide by 25% just by moving everybody to the standards we're already at. So before people just kind of talk down the Canadian oil sands, I'd really like you to do a little bit more homework, and don't use the BNN picture of something sliding around in the mud that they've posted every time for 20 years. It would be like me posting, Toronto's got bad weather 365 all the time. It's not like that. It is dramatically different than it is being presented in the media, and it's really hard to change the narrative. But we have people from Winnipeg reporting that, and they're the energy specialist. We have a person from Toronto reporting, and they're the energy specialist. We don't do that about the car business, about the fishing business, about any of these others. I don't know why we think we can have experts from parts of the province that have never, or parts of the country that have never even seen the oil sands. They've seen a picture from 20 years ago, and they're using that to decide how bad it is or how good it is. The place is wrapped in forest. So if there was greenhouse gas emissions where the CO2 is absorbed by the trees, the very trees that we're now going to spend $3 billion to plant, it really is an asset we should be proud of, and somehow our government has convinced us to not be. So the point I would make out of all of this is try to see through the forest and look in deeply, because we are well set up for this to take off. We get another 300,000 barrels a day from Line 3, which goes from Alberta to Minnesota, Duluth, Minnesota, to the edge of the Great Lakes. And that pipeline normally does 350,000 barrels a day. The pipeline is completed all the way through, and we're now working on the Minnesota leg of that pipeline. The permits were just finished December 1. And so by the third quarter, heading into the fourth quarter of 2021, that extra 300,000 barrels a day should come online. We have the pipeline going from Alberta to the West Coast, and that pipeline was 300,000 barrels a day, and the increased pipeline will start to flow. I think it's late 2022, if I'm not mistaken. And that adds another 600,000 barrels a day. So we're going to potentially have as much as 900,000 barrels a day in additional capacity to change the price of oil from West Texas and the discount that we get for Canadian oil because we don't have access to pipe. That could drop meaningfully, like $5 to $7 to bring that pipe, that difference in line. Now, so what happens if West Texas is $40 or $50 and Canadian oil is only $40? The reason we lose that $10 is because we don't have access to get it out to market. So they can pay us less for our oil because we really have no competitive way to ship it. When we have those two pipes, what happens is now they have to give us world pricing for the oil because they need it. And so that we now get whatever, just the transportation difference from Cushing, Oklahoma to Alberta, call it $2 a barrel. So we could generally just even take only half of the $10 discount we get today. It's actually 12, but let's call it 10, and half of that, another $5. So for CNRL, that's another $2.5 billion in revenue that they get because they can sell their oil. So it is literally set up with probably 5 or 6 major levers to help Canadian oil companies really succeed here over the next 2 years. And we still have rail capacity moving oil today. We still have some pipe capacity. We had to shut in reservoirs because of the price of oil falling. Some of the oil companies went bankrupt, so that oil isn't coming back on stream just yet. So we've got a lot of things that could ramp up over the next 2 years to give us literally the backdrop that it's the kind of thing you wish somebody told you about at the beginning. So hopefully I'm sitting here Christmas 2020 talking about 2021, 2022 as one of the more powerful places to get on board. And literally crude oil is just taking out the summer highs here. It's not like you missed the move. We're just getting going. And the move in the oil companies from here to here, just this $35 to $45 was 50%. So the XOP or the XEG in Canada, let me just go get the chart for you. So the XEG, the Canadian Energy ETF, went from $4 to $6, 50% move in a month, while crude moved up. Now, is it going to move up 50% between January and April? I don't know, but there's enough potential that it could. I think the real picture that if you've got the patience, some of these names, and we're going to go through some of the charts now if you have time, are literally set up to explode to the high side, and we could probably make 4, 5, 10-fold on some of these stocks as they break out. So Whitecap just bought some assets, or actually merged in some assets from Torque Oil and Gas, and when they did that, it makes them larger. And the difference between them just being a small company and a larger company is they might have to have a $2 billion market cap or a $5 billion market cap or whatever. You need to raise your market cap. And the higher market cap you are, the more funds around the world are allowed to invest in you. Well, Whitecap actually has negative carbon output. And the reason is because they take carbon dioxide and they pump it back underground. So they actually take carbon dioxide out of the air and put it back into the ground. We have carbon capture in Alberta. Many people don't know that. We have it in Saskatchewan. We're capturing this carbon. We're taking it out of the air. We're doing a lot of things, but Suncor spending $1 billion on environmental stuff, and we couldn't even get the Prime Minister to fly out and stand beside him and talk about it. So the difficulty in communicating the facts is very, very difficult, but it's not like you're investing in this nasty place on earth. It's really one of the places working very, very hard to try and improve things. So the little move in oil we've had generated a 50% jump in these charts. Now, what I'd like to do, if you've got time, is just quickly go through some of my energy charts and try and give you a picture of how big the opportunity is. So because most of the crowd today is Canadian, I'm going to focus on the Canadian charts. I could also do this with the US charts, but that's not really where I think most of you are investing. So we're going to focus on the Canadian ones. And it's also the Canadian ones that I think have the bigger opportunity. And the main reason for that is having the new pipeline come to market helps us dramatically. The natural gas pricing in Alberta is relatively low, and that's when you drill for oil, you get oil and then there's natural gas in there because it's all compressed, and then as it comes out of the ground, you actually get gas bubbles and oil. But when you drill for gas, you typically get what we call it dry gas. You don't get oil with it. And then the other type of oil you can, or the other type of gas you can drill is called wet gas. And with that, you get condensate, which is the things you need for toluene, ethylene, butanes, a whole bunch of things in the refinery stack that are value added and pay dramatically more, are worth dramatically more. So when we get the Kitimat terminal for LNG going, that will give us access to a lot of natural gas going offshore to China to help clean up their environment and get rid of their coal plants. We'll have two pipelines, the Trans Mountain and the Line 3 done. And perhaps, I think when Joe Biden figures out exactly how desperate America is going to be for energy, we might actually get the Keystone built, but that might just be too optimistic. Anyway, even without that, things can improve dramatically for us, and we can start getting this product to market. So here is ARC Resources, and this one's a little bit natural gas heavy. So you can see the chart has rolled over here, and what I might expect this to do is over by summer kind of roll down to the zero on the PPO. Maybe it's February, March, whatever. And as this starts to turn higher, I would expect us to start breaking out to new 52-week highs and heading up. And natural gas tends to be a little bit sensitive towards winter, and we didn't really get an early cold shock in New York in November. So it's one of the reasons the chart hasn't started to curl up. But the natural gas names are pausing right now. I would suggest that they still have some room. Just keep them on your radar. So here's Birchcliff, another big natural gas name. You can see downtrending, and basically it's paused for the last 2 months. So while oil made the big move and some of the oil stocks have jumped 50 or 100%, I've got some 50%, 70%, 100% gainers in my account today that I just bought literally in mid-September. And these natural gas names have paused. So it's important to understand what they produce, and you don't have to do too much work about it. But there's a lot of different ways to work on this. So here's Bonterra Energy. Hasn't really done anything. So let's not pick this one to be the next winner. Let's just move along and find another one. Here's Baytex. Baytex's ability to generate free cash once things start to improve is pretty meaningful, but they were at a point where nobody knew if they'd actually be able to get through this. We've had a big long downtrend. They're still struggling to kind of get back above here, but this used to be a $6 stock. It's at 76 cents. It's in 2 years, it's 10% of what it was. If it just got back to its highs of 2 years ago when oil was at $65, this thing could be a 10 banger. Just that's crazy. So what I like is this big PPO trend line has broken and it's starting to break to the upside. Cardinal Energy wasn't doing anything. Murray Edwards said he's going to invest in it. He's the primary shareholder in Canadian Natural Resources, Canada's largest oil company. And this thing just literally went from 50 to $1. It's like having Warren Buffett show up into your investing group. So, can this get back to $4 or $5? Oh, well, it's got the right crowd hanging around it. That's for sure. Canonical Energy, they do a lot of work down in Colombia, natural gas company. Chart hasn't done anything for years, so it's not really the first on my playlist. Canadian Natural, we can say the chart hasn't done anything for years, but actually when you think that the oil chart's been declining hard, and this chart is at, call it $32, and they were at $32, $26 in 2019. They're already above their lows of 2019. This company in, I want to say 2017, was doing about 650,000 barrels. Now they do 1.2 million barrels a day. This thing has the opportunity to absolutely soar, and it's Canada's largest. Crew Energy, another small company percolating out of this basement. PPO has broken the multi-year downtrend. It's above zero and starting to head higher. This was a $2.77 stock. It went to 14 cents. It's back to 50 cents. It's up threefold since then. And again, if they can push to the upside here, just to get back into 2018 highs, you're a five-fold gain. Cenovus just bought Husky, so they've done that merger to try and become larger. Li Kai-shing, who's now a Canadian, has got 27% of this company. That's a guy with money, Hutchinson Whampoa. He knows what's going on. And these guys overpaid for the ConocoPhillips assets a couple years back. They paid $17 billion when they should have paid about $8 billion. Not just my opinion, but I was definitely one of the ones who sent a letter to the board. This company really has the potential to do a lot more. And so with the Husky assets, they're very strong in the steam-assisted gravity drainage, and they've got new patents for chemical wash to where you put the chemical in the reservoir. The chemical makes the oil release from the sand and attract to the chemical. You take the chemical out, or you bring it to surface, you take the chemical out, you put the chemical back down the hole, and you send the oil off. It's cleaner than using what we call the huff and puff system, where you pump hot steam down there to get the oil to drip off the rock. So Cenovus, it's been a struggling company for many, many years with mismanagement. And I think probably the benefit of the buying of the ConocoPhillips assets was we got a change in management. And I do think this is one of the better names to own. It's gently climbing up here. If you got any sort of pullback to $6, I think you just want to try and get positioned for the big upturn. These guys have rail contracts. They have a refinery in the States. They're not just a little company. They can do a lot of things here. And I think they actually, with the takeover of Husky, they moved into a larger position than Suncor. So a few years ago, Suncor was the largest. CNRL and now Cenovus have leapfrogged above them. Enerflex, this company makes natural gas processing equipment. You can see it was a $19 company. It's now, it was $6 just a couple of weeks ago. It's now $7. But anyway, tripled just to get back to the highs of last year. PPO has just gone positive, so you get some sort of pullback in here. Again, try not to get, I got stopped out 40 cents below my entry or whatever. Just try and get your picture big enough that you're seeing the longer scope, that once we come out of this COVID and things start to return, jets start to take off. I can't imagine how many people are going to hit the road and just go on a road trip to get out of their house. Quite frankly, I think it'll be stunning. Anyway, Enerflex builds natural gas compressor systems, and as the price of this picks up, I'm fully expecting this stock to be one really big improvement. And they build stuff for the Middle East and for the US and for Canada. So it's a pretty big deal. Enbridge, we've all heard of the pipeline company headquartered here. They're the ones with Line 3 trying to get going. And they're also the ones that are being stopped on the Line 5 going under the Great Lakes. That would put a lot of pressure on Eastern Canada if we don't have that pipeline going. So that pipeline may be a real contentious point for Eastern Canada here within the next year if Michigan's governor is able to stop the flow. Anyway, it's right at resistance level. I don't think I'd buy it for its Line 3 assets, because on a scale the size of Enbridge, it's helpful, but it's not that big a deal. It's more of a bigger deal for the oil companies than it is for Enbridge. It's still big for them. I think it's a $7 billion project, but what's a new Tesla plant? $6 billion or something. So it's a meaningful deal. Trying to get this done. You're not going to get hurt. Your downside isn't that hard, but I don't think your upside is there either. So might be better places. Enerplus is a producer, and it was a $2 stock in November. It was a $4 stock now, almost a full 100% gain here. And you see the scooter ranking going to the highest level in 2.5 years. I just think that's a good message of exactly what the opportunity is. Gibson's owns a bunch of tank farms in and around Hardisty, which is like Cushing, Oklahoma, a major oil terminal hub for Alberta. The problem is that most of their assets, or a lot of their assets, I think, are located at the top of the Keystone XL pipeline and not the Trans Mountain pipeline. So I'm starting to notice this stock underperforming. It's one I've loved, but I actually sold it, and I'll probably let somebody else have that one, and I'll focus on something else. So Husky is the one who got bought by or merged with Cenovus. So this was a $20 stock 2 years ago, $2 just in October here. Merger came in about here. It's now a $6 stock. It's still a triple just to get back to where it was. Now under Cenovus, that volume and management will probably get it going. I love the fact that these 2-year trend lines in momentum have broken. Not even the thrust off the lows could get this trend line broken, and now all of a sudden the deal got it done. So I'm excited about this. High Arctic Energy Services, I just have, I had trouble with this chart, but look at it. They were 55 cents. They're now $1.25. So it's triple in, well, whatever, 250% in 2 months. Lots of these oil service companies could finally start to percolate. Kelt wasn't really doing anything, and they might get it going, but I actually sold it, so I made some money on the stock, but I sold it just because I really thought it should have been breaking out more. They might end up doing some mergers and acquisitions to get going. The Meg Energy, this one, Sherman Schulich, who owns the Schulich School of Business and the Schulich Engineering School in Calgary, who was a big donator to those universities. He was a big metals and mining investor, and he bought 5% of this company in 2019. And again, if you're going to pick a company and the big guys are jumping in, it's not a bad place to follow. Anyway, this stock was $2.14 late October, and it's 4.5 now, like 100% gain in 2 months, and we're just starting to see the price of oil move. If we can get it back, here's an $8 level, here's an $11 level. These are 2-year-old charts. Like there's huge opportunity if the Permian doesn't get built out and we start to see some demand. So here's Mullen Trucking, breaking out of a big base here. It's up to near 2-year highs or 1.5 highs. They move oil fields, so that's why it's on my oil list. But they have a trucking company. They have 30 different trucking companies under the Mullen umbrella, something like that. They're huge. New Vista Energy. This one is natural gas related. I own quite a bit of it, and I keep pausing. Should I keep it? Should I trade it in? This thing was $7.50 2 years ago, so it's $1 now. I just think it's got the upside to go here as things start to improve. If my patience is there, there's no reason it can't get back to that. So I recognize the downsloping chart. They do have a lot of natural gas, so I might have to wait a little bit more for this thing to develop. Precision drilling, we're just starting to see a pickup in drilling activity. Now, one of the reasons that drilling activity hasn't picked up quite as quick as I might have expected was we had some wells that were called drilled and uncompleted. So you actually drilled the well, but because you couldn't sell the oil, you didn't complete the well. So what you do is you go hire a service rig, and the service rig comes and it puts the wellhead Christmas tree on the top of it, and it connects the well over to the piping system that takes it off into the oil delivery network. Until all of those drilled uncompleted wells get connected, we probably don't need to drill a lot. So some of those, Alberta actually had to force production restrictions because we didn't have pipelines and we didn't have pricing that would allow us. So the first holdup we had was pricing, or was pipelines, and the second holdup was pricing. As we come out of this, like this is the first month that we're starting to see an improvement in drilling rigs. I sure don't want to sell the stock here. So this was, this stock just did a 20 for 1 or 1 for 20 conversion. So the stock was uh, just doing the math backwards, it was about $5 here, and it dropped down to, literally nothing. Anyway, with the new conversion, it was $100 stock. It's now a $28 stock. As drilling starts to pick up, and if I'm right, I think this thing starts to ramp. Okay, Pembina Pipeline, same sort of thing. I just don't think you're going to make the big money in the pipeline area. They got lots of things they're working on. I don't doubt it. They pay a beautiful dividend of 7.5%. As things get better for the oil business, these guys will get better. Again, the chart was 37 here, 45. It was up to $50 in February. Nothing wrong with that chart. But again, this could go from, let's say, 32 to 50, whereas some of those oil companies could go, 2, 3, 4 times. Questor, they make some natural gas equipment to try and control methane release and that kind of stuff, environmental improvement stuff. Stock went on a huge run here from $1.50 to $2.50 in 3 or 4 weeks, 40 or 50% gains, pulled back right to support. Not a bad place to look at it. It's one of those little niche applications that I would like to own. There's just so many better things to do. So anyway, take it if you like it. Shawcor, they put the coating on pipes so they don't rust and stuff like that. So they have big yards of pipe, and they have 36-inch pipe and 24-inch pipe and 12-inch pipe. They have pipe everywhere. They're a supplier to the world for pipe. And this chart's starting to improve. Again, it got down to 60 cents. That's just crazy talk. And then we're sitting here at $3, almost $4, but this thing was $25 just 2 years ago. So even if the oil business starts to pick up, this chart's probably, the demand for pipe goes up. Secure Energy Services, these are the guys that are going in, fixing those drilled and uncompleteds. And then if you have a new well come on stream, they also go in and clean up old wells. So my daughter is part of the Painted Pony acquisition at CNRL, and they're going in trying to get some of these Painted Pony wells up and running because they just didn't have the cash to do it. So anyway, you call service rigs to come in and do that. And so that's why these service rig charts are jumping. So they were $1.50 up to $3. I'm just trying to explain the difference between an oil driller and a service company. So the service companies go in, clean up wells that stop performing. Cold weather, there's wax in the crude oil, so it starts to thicken and harden. So they have to melt that wax and get the well performing again. It's that kind of stuff that these service companies come in and help them with. Surge Energy, again, 20 cents a couple weeks ago, up to 40 cents, trying to get going. This is a friend of mine was involved in this company when it IPO'd. I just have to click on it and show you this because this stock IPO'd, and it's just remarkable. It IPO'd at $10 and it went all the way to 5 cents, 6 cents, and now it's starting to bounce off the bottom. It's above the 40-week moving average for the first time since 2017. And, it was a double in the last 4 weeks. And they sell sand that you would put in the reservoir. So when you crack the reservoir to connect the holes together. So you've got a hole. You want to crack the rock so the water or the oil can run out. Well, you actually still need to hold that open. So what they do is they pump in sand, and the sand just holds that reservoir open so the oil can flow back to the well. Okay. Anyway, so this is like literally a few years ago, they sold a whole bunch of shares at $10 thinking that this stock was going to be just fine. And then that's just the implosion we've seen. If we're near the bottom, there's probably some upside, but literally a gambler's delight. Okay, Suncor Energy, again, was Canada's largest. They had a fire at their oil sands facility, so that's a problem. I think the real thing to think about here is it's a great company. It's well run. There's good people there. A yield of 5% if you're picking it up in around today's prices. Again, if it rolls back to $20 or $18, don't get beat up by that. Just kind of recognize that we're in a bit of a COVID wave here where we're trying to figure out as COVID blows through, Again, I come back to, if Moderna can help stop the transmission between people, not just the infection of people, but the actual transmission across people, and get our economy going by stalling the transmission, all of these oil companies should accelerate. And I would expect this one to be a great one. I've seen it listed by some of the biggest value investors out there. $22, it's a deal. I own a lot of it. Trican, well, I don't own this one. It's breaking out of a 2-year base. Why don't I own it? Because I just don't have enough funds to keep putting into oil. I have to diversify a little bit. Here's Tervita Corporation. This one, environmental work in the oil patch. You might think there's a calling for that with the current climate. So anyway, from $2 to $3 in a couple of days. And, we're sitting here just above the 40-week moving average. This thing IPO'd 2 years ago at $10. It's sitting at $3. You're in the environmental business. I'm not sure why. Anyway, Torque Oil and Gas. This one just merged with Whitecap. I mean, it was a beauty to begin with. It was $1.50. It went to $3. So there's 100% for you just between the end of November and the mid-December. 6 weeks, you can get by on that kind of return. Tourmaline, these guys are huge in natural gas. The company is really well run. They have money. They know what they're doing. They're a well-run team. When natural gas kicks off, and probably as the Kitimat LNG project gets going, and they either sell directly into the Kitimat project, or because Kitimat takes all of the other LNG or natural gas away, then they'll end up getting the increased price of natural gas. So don't bet against this company. There's lots of good people there. I took some huge gains off the table in this one, and I'm just waiting basically for natural gas to kind of improve. I don't know if that's April, January, June, but this is one of my go-to companies. I'd love to own it. Again, it's almost back to, it wouldn't take much to get to new 2-year highs. I think this will be one of the big winners, and they've been doing mergers and acquisitions, and they just spun out a small company called Topaz as a royalty stream company. And so that's one division, or they just split it out. I think there's upside in that Topaz. That chart is beautiful. TC Energy Corporation, this was TransCanada Pipeline. The guy's building Keystone XL. I just don't think you have to go there until Biden tells us what he's going to do. And I think there's an opportunity to get around that. It would be a big surprise, obviously, if both Biden and Trudeau had to start working for the oil companies and try to get more Canadian oil. It would be quite a swing. Anyway, Tamarack Valley Energy, this one just broke out on news that it could be the next one to get merged with. Well, what did they do? They decided to do a little bit of buying on their own this week. It's still a good company. It's well run. I don't know if the bigger entity can be sucked up into Whitecap. If it goes it alone and tries to get more of its own assets going. But again, look at this 2-year trend line and momentum breaking. Price has a big 2-year trend line here, just breaking. It's $1. It was $5. That's a 5-fold increase to get back to where it was 2 years ago. If you think oil's going to $65, these charts can literally climb the scale quite quickly because they've got their costs as low as they possibly can. They've been abused by the price of oil, by the government, by just about everybody else trying to kick them down. When these things start to turn, like most of the revenue other than the royalty stream goes straight to the bottom line. So pretty awesome. Vermilion Energy, the stock's okay. I mean, this thing's very volatile. It was $3, went to $6. This is a huge gain. It paid a nice dividend right up until March, and then they stopped paying that dividend stream. A lot of people waiting for that dividend to come back online. Was at 12% on the last one. I don't know what it currently is. Don't use that number because there hasn't been a payout for a while here. That's what these little drip lines are. Is dividend payments. So anyway, this is a great stock. It's probably fine. I think the biggest thing that I would focus on is, one of the things I like to do is I like to go over to 9 Point Energy and look at Eric Nuttall's oil and gas fund and just say, what are his top 10 holdings, and look in there. And again, I like to use the technicals. He's using the fundamentals, probably doesn't care less about my chart. Um, the nice part is if I can find strong chart setups on good fundamental companies from Eric's perspective, it's a pretty easy win-win. So I wouldn't throw the fundamentals out the window, but um, you know, I have to explain how that works briefly. Let me finish the Whitecap story here, and then I'm going to get into just helping with what's going to happen over year end here. So Whitecap Resources, really well-run oil company, basically does a lot of stuff in Saskatchewan. They take the carbon dioxide and they pump it into the ground and use that carbon dioxide to pressure the reservoir, I think, and push up the oil. So uh, this this company gets ESG investing, it gets green investors. They just bought the assets the other day from Torque Oil and Gas, or merged them in, and they didn't pay any premium. They just merged the two companies together. The guys from Torque step aside, and the guys from Whitecap take over. I'm sure they got some stock options to do that. But this was 250. It's $5. It's very close to new 52-week highs. So here's one of the companies already close to their January highs. As things start to improve here, could this get bigger? I think it could easily make it back up to 2018 highs. So just as we look across the company, we see the variation in the charts. I would just say, the ones that are starting to have 50 and 100% gains already, they're the ones the investors are moving to. The natural gas companies like Tourmaline, like NuVista, Arc Resources, Birchcliff, just to name a few. Those ones might have to wait until the natural gas gets going. But literally, there's some upside on those names. I think, like I said, NuVista, I own a piece of it. They do 60% of their business in gas, but it's $1. It was $8 a couple of years back. So is it anything wrong with the company? Not that I can figure out. Okay, so the other thing that you need to know is that each year, as an oil company, you have to tell the government or the shareholders how much oil you have in the ground. Well, you can have a lot of oil, but if it took $150 to get the oil out of the ground, that's not really a valid calculation, because oil price hasn't been at $150 ever. So what you need to do is you need to say, this is how much oil I can produce profitably at the current price. And you could use the 52-week average for crude, which obviously is quite low. So if we go to the crude oil chart, let me just go get it. You're looking for like a 52-week average. So here, I'm just going to change the color on this so it shows up a little bit better. But here's 52 weeks, and we're just going to change it from lime to red or something so you can see it. But the idea being, we're close to the end of the year. So the 52-week average for this year is $40. So if you picked $40, you'd have to say, here's the oil that I could produce profitably at $40. Well, when we did this number last year, it was 55. So the problem is we actually throw away all of the assets. We still own them, but all of the oil that can't be produced profitably at this, the difference between 50 and 40 gets written off. Now, it doesn't mean you don't have access to the reservoir. It just means, in terms of mark-to-market current accounting, you have to say that that's unprofitable reserves at the current pricing. So companies could actually have a drop in reserves, and so that whole thing starts to come out in the middle of Jan, Feb, March. And when they do their annual meetings in April, these numbers are published. So it's not a surprise to investors in the oil business, but it might be a surprise to people who are new to the game. Like, why all of a sudden did they lose all these assets and the stock's going up? It's probably because this has been the trend of the price of oil, down, down, down. And I think the opportunity is for it to start to turn up again. Okay, so I've been babbling quite quickly, but I want to just quickly look over here at the questions and see if we've got any. And if you've got any, please add. Um, Is the upside the same for natural gas? So I think, again, natural gas is a lot more weather related. We have a really big nugget to crack when Kitimat gets going. And let me just help you with a map of what's going on there. So this is I think it's a $30 billion project, and we're just going to pick Kitimat. Kitimat, BC. Okay, so there's Kitimat, and now we're going to zoom out a lot. Okay, so there's the west coast, and see how far this comes in. So these tankers can come all the way in here to get this natural gas rather than having a pipe go all the way out to the far coast. So the water in here is actually relatively calm, and one LNG ship could come in here, pick up, and leave every day and just kind of haul LNG out of this harbor. Okay, what that doesn't do is show you where that is relative to Alberta. So here's Edmonton over here, and this is a really large oil field up here, oil and gas. And so a lot of this natural gas is going to come from this region. But what happens is that oil and natural gas was currently, that natural gas was currently going this way. And now when it starts to go this way, obviously that improves the pricing for both. So when Kitimat gets going, and it's a big project, like it's a really big project. Again, 4 or 5 car plants in the middle of nowhere, small town of 1,000 people, all of a sudden getting an investment. So when you see that kind of thing, it's going to take time. But again, we've just been through one of the biggest crushing bear markets in oil. The majors don't want to drill. Everything is starting to hold it back. As this starts to climb out of the hole, I think you're, again, if you wanted to pick a place to get long, I don't want to wait till $80 oil. There was a guy on BNN the other day saying, I'd leave the energy industry. There's nothing going on there. And, he said, until oil gets to $80, I'm not interested. I'm thinking exactly the opposite. I want to buy it when the stocks are starting to rise because oil's going up. I don't want to wait till oil gets to $80 and now start to buy oil stocks. It's a commodity. So what happens with commodities is you need to buy near the low and sell near the highs. These aren't Shopify where they can continue to grow their business exponentially around the world. It's a cyclical business, and you jump on the train while it's going up. You get a 4 or 5 banger, you sell near the top, you wait for the bottom, and you try and do it again. This is not the business to try and buy and hold. This is the business to buy, run, sell. It's the ultimate trading business. So the one thing I want you to gather all of your energy and try and learn more about Alberta's energy industry if you're not from Alberta. Literally, there's some great articles. I might even just publish a blog with all the good articles to help people understand. When you see the muddy oil mess of trucks driving around in the mud, yes, it's like cars driving around in the snow in Toronto on a snowy day. It doesn't look very good. But literally, there is a lot of work going on to try and protect the environment. And if we could move everybody to Alberta's standards, we could change the world's greenhouse gas emissions by 25%. Just think about that. And if you looked at a map of the Permian, there isn't a tree around. If you look at the map of the oil sands, it is all trees. Again, the oil sands are up over here. There's another one up over in this area called the Peace River oil sands, and they're very heavy oil. But the world also needs heavy oil because they get all the other things in the refinery stack that they use for all of the things we wear and we make. So oil, again, only 25% is transportation based. So after wiping out the oil business, we still had 80 million barrels a day being produced and used. In what could only be the biggest example of stalling everything. Now, there's a lot of people that are hopeful we'll move to electric energy. I have a whole newsletter about electric energy if you're interested, and I'm very bullish on it. I want to be long commodities. I own copper companies and I own commodities because I think it's going to, I don't actually care about the car companies. I want to own these copper mines because to get a mine approved is very difficult. Nobody wants a tailings pond. Once you get it approved, now we need the copper. Now we got to go and use metallurgical coal to smelt it, which nobody wants. Once we finally get the copper in some form that we need, we're trying to get a transmission line approved of 1,000 miles to move, 3,000 megawatts across the terrain. That is huge government regulation to try and get any of that going, not to mention environmental activism, trying to stop everything from happening, like a transmission line or whatever. So the move to electric, while it has support from so many levels of government and everything else, it is not imminent. And if it is imminent, the big thing, again, copper's at 7-year highs. That's telling you something. You want to get in and you want to start owning some of these, because it should be a ride for the roses over the next 10 years, watching people try to buy copper, and there's no copper mines. So anyway, somebody just asked about the uranium stocks, and I have to agree. The uranium stocks are beautiful. Cameco just broke out to new 7-year highs. Let me go get that chart. Can you tell I'm excited? I just think this is going to be such a good year. So here, let me actually use the Canadian ticker. So here's Cameco. Put it on a weekly chart, and let's just ride this thing out a little bit to 10 years. Give a little bit of optimism as to what's going on in the uranium business. And what we see here is if I drew a horizontal line at $16.50, the idea being that this horizontal line represents the 5-year highs, and we're just breaking out. I mean, it's as good as it gets. Remember when gold broke out of this? This is what happened when gold broke out of a big 5-year base. What level do we want that at? Call it 1375. That was $500 ago. So when gold broke out from here, this was a big, beautiful move for a year and a half. Yes, it had 6 months of downtrend in here, but a big push, pull back, and then, a nice big surge up. That's the kind of thing that Cameco did this week, and copper did in May, and oil's about to do. And so I think that is the opportunity. If you were looking for other uranium names, maybe I'll just go to my chart list and you could take a screenshot, because there's only a few names in there. But where am I? LMNOPQRSTU. So I break my chart list down by industry, and so this is for uranium, so nuclear. And then what I do, these are the kind of miners, not the power companies that actually generate power. And so we're just going to go into view all mode here, and I'm just going to put it on summary. But this is the move over the last 1 week. 26%. So it gives you some names to at least work with, and there's the ticker symbols on the right-hand side, and you could work with that. So just give yourself a screenshot if you need those. Any other quick questions? And we're getting onto 2 hours here, so we should probably wrap it up. But I want to make sure that I've answered all of the questions. And if I haven't already done it, I want to make sure I wish everybody a wonderful 2021. I'm hoping it's euphoric and a lot better on everything, just getting us out of this COVID situation. So hopefully you feel the same way. But all the charts line up to me for optimism. I'm a little worried about why China made 4-week lows this week, but I'm pretty sure once we see the whole world kind of getting out of this COVID situation, so not only just getting the vaccine to stop getting sick, but getting the vaccine to stop the transmission, I literally think we're going to have the most euphoric travel and optimistic environment around us for a while, and that should help drive global growth. And a lot of these recovery names uh, should probably do very, very well. Anyway, thanks for taking the time. Have a wonderful Christmas holiday, or happy holidays, and we look forward to seeing you in the new year. Thanks, everybody.
Great. Thanks, Greg. I think we can log off here. If anyone has any questions about announcements of the CSTA, they can contact me, or we can deal with it, or we can talk to that the next CSTA meeting in January. Thanks, everyone.